The unemployment rate is low. The stock market is up. GDP is growing. So why does everyone you know feel broke? The answer is that the numbers we use to measure the economy are hiding something. And once you see what they're hiding, you can't unsee it.
Diane, this number shows a slowdown in the economy in the final 3 months of last year. That 1.4% GDP growth is about half of what economists were expecting. So
here's what the official scoreboard says. The U.S. economy grew over 3% in Q3 2025. Unemployment sits around 1% by historical standards. That's basically full employment. Corporate profits are at record highs. The S&P 500 has climbed over 130% since the pandemic began. Every major headline measure says, the economy is fine. Now here's what the people living in that economy say. In January 2025, 59% of Americans reported they couldn't cover an unexpected $1,000 emergency without borrowing. Not a car breakdown, not a medical bill, $1,000. More than half the country. The University of Michigan Consumer Sentiment Index fell to an all-time low in May 2026, lower than during the 2008 financial crisis, lower than during COVID. Grocery prices are up nearly 30% since the pandemic started, and they have not come back down. The personal savings rate has dropped 32% in just over a year, and total household debt just hit $18.8 trillion, a $4.6 trillion increase since 2019. The economy is growing, and millions of people are getting poorer inside of it. So what's actually going on? First thing people get wrong about this is wages. When inflation started cooling, the narrative became, wages are rising faster than inflation now, so people are catching up. Problem solved. Except that's not how math works when you've already fallen behind. From January 2021 to July 2025, average hourly earnings in the U.S. went up 21.8%. That sounds good, but over that same period, prices rose 22.7%. So in real terms, what your paycheck actually buys wages are down 0.7% cumulatively. Workers are earning slightly less in real terms today than they were in 2021, despite years of nominal raises. Put another way, you got a raise. It just didn't keep up. But this wasn't even the craziest part. The thing the CPI doesn't fully capture is what's called shrinkflation, when companies quietly reduce the size of a product instead of raising the price. Same box, fewer chips, same bottle, less shampoo, same bag of coffee, fewer ounces. The price stays stable. The CPI doesn't flag it, but you're paying more per serving without anyone telling you. According to a UMass Amherst analysis, true food inflation was understated by 3.7 percentage points for years because CPI measures price per package, not price per ounce. Packaged food sizes shrank an average of 14.6% over 7 years. You were being charged more for less, and the official inflation number didn't fully count it, so real wages are already down. And then the actual cost of living is higher than the headline number shows. The gap isn't a vibe, it's arithmetic. When wages don't cover costs, people do one of two things: they cut back or they borrow. Most Americans are doing both and running out of room on both sides. Credit card balances just hit $1.28 trillion in Q4 2025, a 66% rise since early 2021. That's over $500 billion in new credit card debt in less than 5 years. The average cardholder carrying a balance owes $7,886. At a 21% APR, which is today's average, that person is paying roughly $1,655 a year in pure interest, not paying down the debt, just servicing it. That's money that generates no asset, no savings, no return whatsoever. And delinquencies are climbing. Over 7% of credit card balances are now 90-plus days past due, a level the Federal Reserve hasn't seen since the approach of the 2008 financial crisis. In the lowest income zip codes, serious delinquency rates have already crossed 20%. Meanwhile, savings are evaporating. 27% of Americans have no emergency savings at all. The median emergency savings balance is $500. A student loan borrower was defaulting every 9 seconds in 2025. The picture isn't people living beyond their means by choice. It's people using debt to afford what used to be covered by income. But here's what makes this a structural story, not just a personal finance story. Economists have a name for what's happening. They call it the K-shaped recovery. Picture a K. The top arm curves upward, the bottom arm curves down. That's two different economies running in parallel inside the same GDP number. The top 20% of income earners now account for nearly 60% of all consumer spending. Their wealth has soared because they own stocks and homes, and both have gone up dramatically. The S&P 500 gained 130% since 2020, but the top 10% own 93% of all stock market wealth. When markets go up, the bottom 50% capture about 1% of those gains. So when you hear the economy is growing, what that often means is the people who already had assets saw those assets appreciate. The GDP number counts that. It doesn't tell you whether the median household, the one without a stock portfolio, with a fixed salary and a grocery bill, is better or worse off. Mark Zandi, chief economist at Moody's, said it plainly. For the bottom 80% of Americans, overall spending hasn't outpaced inflation over the last 6 years. That means no improvement in economic quality of life, not a slowdown. 0. There's also a structural reason wages haven't kept pace. Since 1979, U.S. productivity has grown 6%. Median hourly pay has grown 17.5%. The economy got enormously more productive. Workers got a fraction of those gains. The St. Louis Federal Reserve found that 76% of recent profit growth went directly to shareholders through dividends, while worker compensation captured a shrinking share. The economy grew. The growth just didn't reach the people doing the growing. Here's the uncomfortable conclusion. The reason the economy looks fine is partly because we're measuring it wrong. GDP tells you how big the economy is. It doesn't tell you how that size is distributed. Unemployment counts people with jobs, but not people working 2 part-time gigs because they can't find full-time work, or people who gave up looking entirely. The CPI tracks prices per package, not per serving. Every metric we rely on was built to measure aggregate output, not household financial reality. When people say they feel broke while the economy looks fine, they're not being irrational. They're not being tricked by doom-scroll headlines. They're accurately describing their own lived experience, which the headline numbers are structurally unable to capture. The recession is real. It's just that the vibe is tracking something the data hasn't caught up to yet. The economy is growing, just not for everyone in it.